and 25 basis point fee is losing 37% of your money. You understand? Like it's like I take a third of your money. Okay. So if you're a Bitcoin investor, having low fees means you invest 1 million and you get to keep the million. Having high fees mean you invest 1 million and you lose 300,000 of it over the course of 20 years. So those low fees are, well, where is that going to manifest itself? It's going to drive the price of the asset up, right? First of all, because the people that own the asset aren't losing 1 or 2% of their money every year. But second, because there are a lot of people that they will either invest $1 million in it or nothing, right? So if I like it, I'll just invest 1 million. If I don't like it, I'll invest nothing. So you start to see money flowing from gold into Bitcoin, from real estate into Bitcoin, from the S&P index into Bitcoin. And so that's a big deal. So the launch of the ETFs, it's been very successful. This is the ideal type of asset to put into an ETF wrapper. It's definitely it's the global asset. It's the biggest brand. Everybody knows what it is. It's actually the best thermodynamically sound investment on Amazon. Everybody hated it. You know what they said? They said, oh, this is an awful retail company. They don't make any money. Well, they kept not making any money while they sucked the entire market up. And now there's Amazon, Walmart, and everybody else is bankrupt, right? 20,000 retail companies fail. 1 or 2, Amazon, Walmart, Target kind of are there. And then Amazon runs by everybody. It's because everybody, who doesn't want to have everything they want delivered to their door in 1 hour for free? Who doesn't want that? Just like with Google, I want to go and I ask a question, I want the answer instantly, quick, and I want every book and every piece of information that the human race has at my fingertips instantly. Well, who doesn't want that? Everybody wants that. How about YouTube? Okay, well, it's everything you want to know for free instantly, everywhere in the world. Okay, so everybody's eventually going to need it. Billions, there's YouTube videos. They've got 9 billion views, on the video, right? So everybody wants it. Nobody can stop it. But then again, everybody thought it was a stupid idea, right? They didn't really get it. And the same was true with Apple. It's like people just didn't get it. And I'm like, well, at a dentist, you give them your money, you give them your life savings. They charge you 2% a year, and then they take 20% of the upside. And then they tell you that it's too dangerous for you to own Apple. It's too dangerous to own Bitcoin. It's too dangerous to own Google. You can't do that. That's irresponsible. So here's what happens next. You give them $1 million at 2 and 20. And if you actually understand statistics or financial modeling, and then you just take that $1 million and invest it in the S&P index, and the S&P were to go up 10% a year, they get 4% a year and you get the other 6, which means that you just gave them 40% of your money. You had $1 million and you just gave them $400,000 and you got the other 600,000 back. And so if you ask yourself the question, who are the people telling you diversify? It's the people selling you the diversified funds, or they hold themselves out as these brilliant diversifiers. And what they're really doing is taking all your money, right? And on the other hand, name a billionaire that got rich by diversifying. Jeff Bezos didn't get rich by diversifying. Mark Zuckerberg didn't get rich by diversifying. The winners. And if you pick the winners, yeah, you do better than the index. If you pick the index, at least you brainlessly got some winners. But of course, Bitcoin outdid them by a factor of 3 or a factor of 2 to 3. So why was that? And the answer is by 2020, 98% of the people didn't disagree with you if you said Amazon was a good idea. See, by 2020, most people agreed with you that Amazon was a good idea. Most people thought, well, Google, Apple, Amazon, Facebook, they're monopolies, and Microsoft. Once everybody knows they're monopolies, once everybody knows they're unstoppable, once everybody knows that they need them, then you're not going to get a 10x or 100x performance anymore, because all the capital is already moved into the market. Now, there's two problems with investing in those Magnificent Seven stocks today, in my opinion. Uh, and the one problem is everybody knows they're good, and everybody knows they're essential, and so the market is adjusted, and that means that they're not undervalued. The second problem is you have to think outside the box, and that means if you're in a war zone, you got to leave. If you're buying currencies that are denominated in a collapsing currency, whether it's a peso or a lira or a naira or whatever, you got to get out of that currency. If you're buying currency derivatives denominated in dollars, forward discounted, and the dollar is going to be inflated at 7-8% a year, well, that's your hurdle rate. You're going to have to grow your cash flows faster than 8% a year. Now, how many companies can grow their cash flows 15% a year for the next 20 years? Okay, now you might find some. Now, the question is, can you protect them against politicians, foreign and domestic? Right? If your local politicians like you, will the foreign politicians like you, or vice versa? So those kind of investments, they're very fragile, and I think you got to be aware of them. And so I guess that's why these idle assets, and there's a lot of reasons for them, but one reason is because they feel like their money is safer there. So in the 20th century, people basically bought sports teams. I mean, ask yourself, what do rich people own when they get rich? They bought sports teams, they bought real estate, they bought companies, they bought land, they bought timber rights, they bought oil rights, they bought gold, they bought, bonds. They just bought stuff. Why? Because they knew if they left their money in the bank, it was going to dwindle away. Buy anything. They buy Picassos, they buy art, right? They buy stuff. So there was never a perfect digital capital. There was never a digital instrument where I could, like, if you were a rich Russian and you had a choice between buying a bunch of real estate in Moscow or buying Bitcoin, well, with ex post facto hindsight, looking back for the last 30 years, okay, now let's play that out, and you're rich now 2034. So it's about 10 years. And I'll tell you why. Because 93.5% or so of the Bitcoin was mined at the beginning of this period. But in November of 2034, 99% of all the Bitcoin that will ever be issued will have been issued. And so that halving is very symbolic. People talk about Bitcoin, issuance coming out over the next 100 years, all the way till 2140. But the truth of the matter is, the last 100 years, you're only getting 1%. So think, and actually, of that 1%, 90 basis points of it is coming in the 12 years that follow 2034, and then it's 10 basis points, 1/10%. But practically speaking, all of the block rewards are de minimis starting in 2034. It's 1% over 100 years may as well be nothing, because the daily volatility and the